Hello everyone, this is Xratios Investor. Please note that this video is for educational purpose, and please still do your own research. If you liked this video, please give me a thumbs up and hit the subscribe button. Before talking about 3 stocks to buy in March 2019, I just want to make a quick comment about the 3 stocks to buy series I have been making. To be fair, I haven't been making this series for January and February just because I got a little unmotivated, and most importantly sometimes I feel that it is better to focus on just a few stocks. Imagine investing in 30 over stocks in your portfolio as well as consistently needing to spend your time in researching and tracking on the 30 stocks. Tiring, right? I am not saying you are incapable, but I don't think everyone is suited for it. I believe a portfolio of 10 to 20 stocks is a good number of stocks to own just because of the consistent effort you need to put in. Now back to the topic of what this video is originally intended. The first stock is a stock that I believe everyone is following closely, JD.com under the ticker symbol JD. JD, known as China's largest direct retail infrastructure service provider, has captured the hearts of many investors for its fast growth, expansion, advanced AI technology and drone delivery. Unfortunately, as we all know, the second half of 2018 has been a nightmare year for JD due to bad news followed by worst news. Trade war, rape allegation, and most importantly the slowing sales growth figures that fell below expectation, preventing the stock from making its upside. So the question remains if JD is still a bargain after dropping to over 50%. In my opinion, yes, and here's why. Reason number 1, the rape charges on CEO Richard Liu was eventually dropped due to insufficient evidence. Sadly, some investors remain skeptical on this stock as Liu and JD's reputation has been tarnished. But the good news is that things heals over time. Liu still has a lot of opportunity to rebuild his reputation and the company's image in order to regain investors' trust. Unless there's another allegation or if somehow Liu divorce rumors were indeed true, then JD's image could suffer another setback. However, as of now, I just don't see this happening again after seeing this news. Reason number 2, we all know trade war is a pain for investors and no one knows exactly when the trade war will end. I have read countless of news and my verdict remains the same, that is, trade war will eventually end. In fact, I believe that the trade war might end sooner than we think, as Trump has further said that negotiation made substantial progress. Think about it, guys. One of the main reasons for trade war to begin with is mainly political victory for both countries. I believe that tariff rise is inevitable and the aim for China is to stall and keep the tariff as low as possible, as China is sure that they can't stop the tariffs from going up. My point is, patience is the key here. Reason number 3, JD is ahead of the game in the world with its AI system. The purpose of AI is to enhance China's manufacturing capabilities. Fortunately, this is a technology hugely backed by the China's government, as the government has created policies to encourage the development of AI, automation, and robotics. In 2016, authorities released the Robotics Industry Development Plan for the next 5 years, outlining targets and strategies for growing the robotics industry. The truth is, JD already possessed some of the largest drone delivery system, and tested out delivery services as well as driverless delivery not long ago. What's more is that JD has opened its first JDX Future restaurant with plans to open 1,000 more that is fully controlled and run by robots through an AI system. I believe automation is the way to the future that could further reduce the employment cost while improving the manufacturing capabilities. Also, I have been hearing how everyone loves this stock due to its massive potential and valuation. I feel the need to remind investors the reason they invested in JD in the first place. After all, JD is called the Amazon of China due to its similar business model to Amazon, with nearly 92% of JD's revenues coming from direct online sales, only accounting 16.3% in the retail e-commerce sales share in China. But bear in mind that JD only started its online business 15 years ago. With JD's further international expansion plan with the backing of top companies like Walmart, Google and Tencent further shows JD's long-term goal and ambition. Certainly business model in the US will be challenging, but JD's partnership with Walmart could ease that and provide access to a large-scale logistics and distribution network on par with Amazon's. In this case, execution would have to be flawless. For me, JD presented an extremely good buying opportunity at the current price of $26. I think 2019 could be the year for JD, as I can see JD rebound back to $40 or even break past the previous high. Do keep in mind on the upcoming earning report on February 28, 2019, as JD has only surpassed estimates once in the trailing 4 quarters. It is highly advisable to initiate a position after the earnings report. Stock number 2 is what I believe to be a stock that will play an important role in 2019, Nokia under the ticker symbol NOK. I am pretty sure at this point some have already heard of 5G technology, as telecommunication companies are hoping to transition from 4G to 5G by 2020. In my previous video when I talked about Warren Buffett's top 5 stock holdings, I had strongly emphasized the one most important factor behind Warren Buffett's investment, that is the continual consumer users in the next 10 years or more, and this is the criteria I see Nokia striving in. Of course, before I explain on why I am bullish on Nokia's 5G, I want to give you guys an idea on how Nokia has been performing in terms of the numbers and valuation standpoint. The stock is currently sitting at $6.12, and looking at the chart within the last 5 years, Nokia has not been doing great or bad, as Nokia stayed within the $5 to $6 range throughout the years. As of recently, January 25, 2019, Nokia soared to an impressive 7.14% to $6.60, only to fall back down as many people decided to take profit. Nokia currently has a market cap of $34.3 billion. In the recent fourth quarter earnings of 2018, Nokia reported 15 cents earnings per share, beating analysts' consensus of 14 cents by 1 cent. With revenue of $7.84 billion, compared to analyst consensus of $7.61 billion. Here's the exciting part on why I am bullish on Nokia's 5G. Nokia revenue beat is driven by its strong 5G customer engagement in all key markets, as Nokia is extraordinarily well positioned in the 5G market. Nokia has more than 20 5G contracts, and almost 100 5G engagements with customers in every region of the world, and recently did field testing standards-based 5G services in Los Angeles with Sprint. What's more is with Huawei blocked from 5G rollout in various countries, I believe Nokia could become the world leader in 5G, as Nokia has the right portfolio at the right time to meet that need. This is a stock that I would consider as not only a safe stock but also with a huge potential to grow. Also, considering the fact that Nokia has a forward dividend of 3.96%, I am growing to like Nokia more and more. Stock number 3 is often considered as the safe marijuana stock, KushCo Holdings under the ticker symbol KSHB in the US market. For those who don't know this stock already, KushCo Holdings, initially called as Kush Bottles, is a California-based company founded by Nick Kovacevic and Dallas Mbimbo back in 2010. KushCo Holdings is a parent company to a diverse group of business unit to Kush Supply Co., the hybrid creative, Kush Energy, and Coletto Packaging Solutions. Interestingly, KushCo does not have any direct involvement with cannabis plant or any products that contain THC or CBD, as KushCo is an ancillary marijuana stock that focus in providing packaging, containers and solutions in the cannabis, CBD and other related industries. KushCo is important to the legal cannabis industry as it provides demanding products and services. KushCo has now sold over 1 billion products and maintained over 5,000 legally operated cannabis clients across North America, South America, and Europe. KushCo has seen a huge increase in the stock price back in January 2018, with an all-time high priced of $7.13 only to drop a low of $3.89 in late 2018. KushCo is currently priced at $6 at the point of time as I made this video. KushCo recently reported revenues of $52.1 million for fiscal 2018, 177% sales growth year-over-year compared to $18.8 million in fiscal 2017, and the company expects fiscal 2019 revenue to exceed $110 million. The company's selling, general, and administrative expenses skyrocketed to $25 million from $5.9 million in 2017. KushCo also reported a net loss of $10.2 million, which reversed the 2017 profit of $69,000 as the company faulted on the reduction of inventory adjustment. Not quite impressive, right, with the net loss? However, CEO Nick Kovacevic said that the company dipped into losses on purpose because after a recent fundraising round, it planned to grow its top line before it swings back to profitability in 2020. So, when it comes to the fundamental standpoint, normally investors will turn their head away from this stock, but I realized investors are still betting their money on this stock for the rightful reason as I research deeper. There are 2 reasons why I think this ancillary stock managed to keep the investors' interest. Remember when I mentioned about the 5,000 growers that the company is already servicing earlier? In 2017, the company had 4,000 legal cannabis clients and has already seen almost an increase of 25% from a year ago to 5,000. A large part of that is thanks to its strategic location in the cannabis market. In other words, a strong footprint in the U.S. cannabis market to as many as 28 states, including the 5 largest U.S. cannabis market in California, Washington, Colorado, Massachusetts, and Nevada. What's more is the company has strong presence in Canada and Europe as well. I believe this one reason alone, in my opinion, tells a lot about the company's potential, because I believe getting ahead of other competitors provides a massive advantage. Of course, this sole reason alone is not sufficient to justify why I like this company. While this stock is known for its packaging specifically for cannabis products, it is not only limited to packaging, as KushCo has developed multiple strategies to further expand the company using the acquisition method. KushCo acquired Summit Innovations, a vaporizer brand that sells products to turn cannabis into CBD oil, as well as The Hybrid Creative, a multimedia creative agency in charge for building influential cannabis brands for companies in website development, marketing and product design. I do expect to see possibly more acquisition along the way with the company in using the similar method, share dilution like Aurora Cannabis. Do expect to see challenges along the way, as I believe the continual losses in the short term would suppress the stock from a dramatic increase. Eventually, you will realize that it is a stock you to own once the company has proven the sales growth. Another thing to consider is until edibles and infused beverages are approved by Parliament, margins could prove challenging. Until then, patience is required. Also, KushCo Holdings could be listed in the Nasdaq or New York Stock Exchange as early in the first half of 2019, as the company has been focusing on IPO for the past several months. But do note that while the New York Stock Exchange allows more institutional investor to buy shares, it does not mean the stock will surge as we have seen previously with Aurora and Aphria. Overall, I like KushCo's ability in meeting the needs of U.S. marijuana businesses. I believe that KushCo still has plenty of room to grow along with the overall U.S. marijuana market. Remember, 10 states have already legalized the sale of recreational marijuana and 33 states with legalized medical marijuana. KushCo's sales should rise as these markets mature. Although I like this stock, but bear in mind that this stock might take longer than expected to soar despite all these positive points, as it needs to prove itself in terms of generating positive revenues. That's all I have for this video. As always, do note that speculation caused people to pay no attention to stock valuation and consideration, so please exercise the stock with caution and please still do your own due diligence. Subscribe here for more stock videos, and leave a thumbs up if you liked this video. Comment down below, let me know what you think and how the stock market will perform in 2019. Till next time.